Something just doesn't add up. As we brace for yet another trading session in the red, there's a growing anticipation the Fed is going to step in with rapid rate cuts. But the Fed and markets, they're just not aligned. On the left-hand side, in blue, that's the probability the Fed won't cut interest rates in June. In yellow, S&P 500. As stocks have plunged recently, so have the probabilities that the Fed will not cut rates. In other words, the stock market route is associated with a really high expectation the Fed's going to cut rates sooner than expected. Well, on the right-hand side, that's non-farm payroll. That was released this past Friday. It was actually pretty good. 228,000 jobs created, far better than the estimate of 140,000. So we're seeing a dichotomy here between growth that's not really cooling, but the Fed futures in a panic. Meanwhile, the Fed, well, they're expecting a bumpy road. This is from their last projections released after the meeting. The real change in GDP by the end of the year is expected to be at 1.7%. Well, so far, GDP is at 2.5%. It's not yet dropping. Of course, it's not taking into consideration what happened last week. But so far, that's just the stock market. It's not yet the economy. In other news, in the Fed projections, they expect 4.4% unemployment, with the latest unemployment levels at 4.2%. That's better than what they expected to be by the end of the year. Also, the Fed projections cite PCE inflation 2.7%. Right now, PCE is at 2.5. Also, core PCE, excluding food and energy, at 2.8%. That's what they expect. Well, right now, core PCE is at 2.8%. So they're expecting cooler growth and rising inflation. But with those expectations, given where they are right now, the Fed is in no hurry to cut interest rates. They say themselves are very data dependent. They want to see how the data develops. They don't see 2.8% core PCE or 140,000 non-farm payroll jobs or 4.2% unemployment. They don't see that as reason to panic. And so far, those numbers haven't changed. Now, the Fed futures expected aggressive rate cuts. On the left-hand side, in red, we have a 37% chance by May the Fed will cut rates by a quarter point. In June, we have a 59% chance of a quarter point cut. And by July in blue, we have a 58% chance they'll cut by half a point. In fact, by September, the market's now telling us we have a 50% chance we'll be 3/4 of a point lower. So the Fed funds futures are expecting aggressive rate cuts, especially considering where we are just a couple weeks ago. But again, this is in direct response to the bond market, the yields dropping precipitously, stock market dropping violently. But so far, the economic data has not changed. And again, per the Fed's words, they're data dependent, and they want to see multiple months of growth cooling, jobs cooling. But the problem is, if the tariffs are implemented as we expect, that could be inflationary. Now, the point is, and I think the real takeaway here is opportunity occurs when there's a gap between the market and expectations. Right now, the expectation is the Federal Reserve is going to cut interest rates aggressively in response and to help out, the stock market. But the Federal Reserve is not really in charge of the stock market. They have a dual mandate, to support positive job growth and also to cool inflation or keep inflation at bay. And so far, those two metrics haven't really changed. So if the Federal Reserve does in fact step in and cut interest rates, that'll add M2 money supply to the market, and that should support stocks. So far, the stock market does not anticipate that, and that's the real disagreement here. The Fed futures, the bond market, looks like they're expecting a Fed cut. The stock market's not acting like that. Now, this week, the economic calendar has a lot, but it's not just the numbers. It's also a slew of Fed speakers, which normally we may not pay a special attention to. But what they say, of course, they're going to mention the stock market, could really shed some light and could even turn markets. So it's important to note. On Monday, Tuesday, and Wednesday, we have Fed speakers, wholesale inventories as well. On Thursday, the consumer price index, that's really big. Also, Fed speakers. And then on Friday, we have the PPI, producer price index, as well as more Fed speakers. Certainly enough catalyst to move the market one way or the other, either through the published schedule numbers or something that a Fed speaker may say as well. And we're going to be watching all of this very closely, and we'll be sure to be back here with any significant developments. We hope this has been helpful. We look forward to seeing you back soon.